Imagine this. You're at a grocery store. You've got two people standing in the same checkout line, buying the exact same things. Same total, same items, same everything. But one of them walks out paying less than the other. Not because they had a coupon, not because they negotiated, not because they got lucky. The only difference? One of them used a credit card. The other used cash. Now, here's the thing most people get completely backwards. They think credit cards are dangerous. They think they're a trap designed to steal your money. And for a lot of people, they absolutely are. But for a small group of people who understand how they actually work, credit cards are one of the most powerful financial tools sitting right in their wallet. So today, let's talk about credit cards, what they actually are, why most people get burned by them, and how the people who win with them think completely differently.
Let's start with the most common belief people have about credit cards. They're dangerous. Avoid them. Pay with cash or debit. And honestly, that advice makes total sense on the surface, because everywhere you look, you see the damage. The average American carries over $6,000 in credit card debt. Interest rates can climb as high as 30% or more. People spend years paying off one vacation, one bad month, one emergency they weren't ready for. So the natural instinct is, stay away. Don't touch it. It's a trap. But here's what that thinking misses. The credit card itself isn't the trap. The behavior around it is. And if you never understand how it works, if you never go under the hood, you'll either avoid it completely and miss out on real benefits, or you use it wrong and get buried in debt. Neither one is a winning position. So let's actually look inside this thing. At its most basic level, a credit card is a short-term loan. Every time you swipe, the card company is fronting you the money. You're not spending your own money in that moment. You're spending theirs. And at the end of the month, they send you a bill. Now, here's where it gets interesting. If you pay that bill in full, the entire amount before the due date, you pay zero interest. Not a little interest, zero. The bank lent you money for free. If you don't pay in full, if you only pay the minimum or you pay part of it, that's where the machine turns on. Interest kicks in. And credit card interest is not like a gentle tax. It's aggressive. It compounds. It snowballs fast. This is why people get burned. They think the minimum payment is fine. They think, I'll pay it off next month. And suddenly 1 month of spending turns into 2 years of debt. But let's stay with the person who does pay in full. Why would a bank lend you money for free? Here's the business model. Every time you swipe your card at a store, the bank charges the merchant a fee, usually somewhere between 1% and 3% of the transaction. The store pays it, not you. It's built into the price of doing business. The bank makes money on millions of these tiny transactions every single day. And to keep you swiping, they give some of that money back to you in the form of rewards. Cashback, points, miles. So in a strange way, every time you use a credit card and pay it off, the bank is paying you a little bit to use their card. The merchant pays the fee, the bank takes their cut, you get a slice of the rest. This is why that person in the checkout line pays less. Not dramatically less, but over a year of consistent spending, those rewards add up.
Now, here's the psychology behind why this goes wrong for so many people. There's a concept researchers call payment decoupling. When you pay with cash, you feel the loss. You physically hand over money. Your brain registers it. There's a small pain associated with that exchange. But when you swipe a card, that pain disappears. The transaction feels invisible, abstract, like you're not really spending anything. Studies have shown that people consistently spend more, sometimes significantly more, when paying with a card versus cash. Not because they're reckless, but because the brain simply doesn't process it the same way. And credit cards take this one step further, because you're not even spending this month's money. You're spending next month's money. The future version of you will deal with the bill. Present you just gets the thing.
This is the trap. Not the card, the psychology. The banks understand this perfectly. They designed the product knowing exactly how the human brain works. The reward points pull you in, the smooth swipe keeps the pain away, the minimum payment option creates the illusion that everything is fine. And for most people, who were never taught how to think about money, they walk right into it. But once you see it, you can't unsee it.
So, what does it actually look like to use a credit card the smart way? It comes down to one rule, one habit that separates the people who benefit from credit cards versus the people who get crushed by them. Never spend money on a credit card that you don't already have in your bank account. That's it. That's the whole thing. If you have $500 in your account, your credit card spending limit for the month is $500. Not the credit limit the bank gave you, not what you think you might earn next month. What you have right now. Because the card is just a tool, a conduit. You're routing your spending through it to collect rewards and build credit history, and then clearing it completely when the bill arrives. The moment you start spending money you don't have, the whole math flips. The interest you pay will almost always be more than the rewards you earn. The bank wins, you lose. There's also a second benefit people underestimate: credit scores. When you use a credit card responsibly and pay it off consistently, you build a track record, a financial reputation. Lenders, landlords, even some employers look at this. A strong credit history means you qualify for lower interest rates on loans, better terms on mortgages, more options when you need them. Avoid credit cards completely for your whole life, and you might reach a point where you need a big loan and have no history to show for it. It's like showing up to a job interview with a blank resume. A third thing worth knowing: credit cards often come with protections that your debit card doesn't offer. If you get charged for something you didn't buy, disputing it is much easier. Some cards offer purchase insurance, travel protection, extended warranties. These aren't flashy, but they're real. The key is to treat your credit card like a debit card in your mind. The money is already allocated. You're just using the card as the payment method.
Here's the thought I want to leave you with. Every financial product that exists was designed by someone who understands human psychology deeply. Banks didn't accidentally create something that makes people go into debt. That's part of the design. The minimum payment exists to keep people paying interest forever. The high credit limits exist because spending more than you have is a feeling your brain finds surprisingly comfortable, until it isn't. But knowledge is a circuit breaker. Once you understand that the pain of payment is designed to be invisible, you can make it visible again. You can check your balance before you swipe. You can set a budget. You can treat the due date like a non-negotiable. Credit cards are not good or bad. They're a mirror. They reflect your habits back at you. If your habits are solid, they reward you for it. If they're not, they amplify the problem. The people who never get taught this, who grow up hearing credit cards are dangerous, stay away, they either avoid a useful tool entirely or they pick it up without knowing how to use it. You now know how it works. The question is what you do with that. Like the button and subscribe channel for more finance tips and trap.